Hey guys, what's up? This is Tony from alphapursuits.com. In this video, I'm going to talk about why I'm trading longer days to expiration options. So you might have heard or seen from some other websites that they talk about 45 days to expiration is the optimum options to trade. And in fact, I took this graph from tastytrade.com. And in case you are interested in take a look at that, this is located at this particular SPX ion condor strategy, which I'll talk about it in a different video, but I'll put the link below the video so you can get to this graph in case you want to take a look at it in detail. So I took this from tastytrade.com, and obviously they talk about 45 days to expiration option. This is why there's a line there. And they were talking about 3 different strategies. I think this was about SPX or XPY. So one strategy was selling at the money options, and then 70% out of money, 90% out of money. And what they looked at here is theta. So basically decay of time value. So as you can see, it remains pretty high. And then after 45 days, it kind of jump up a little bit, interestingly enough. And then it start dropping. So what they are saying is if you sell options at around 45 days to expiration, you can still enjoy quite a bit of that high theta decay. And then obviously, you want to make sure that the implied volatility is high and you can benefit from that. But then when I look at this graph, I kind of thought, well, wait a minute, what if I trade 75 days or even longer days to expiration options? Because theta, the time decay value is really high. And then I can still do the same with the implied volatility as well with those longer time to expiration options. Not only that, the price range when I look at that I can set up for the same delta trade, it's actually a wider price range with the longer days to expiration options, which I'll explain in a bit exactly what that means. But if you don't agree with me, please do leave your comment in the comments section. I would really like to have this kind of conversation. I think we sort of lack that kind of opportunity to discuss this kind of new ideas. So I would like to do that if you are interested. So let me show you exactly what I mean by wider price range. So here's a options that I traded recently, JD.com, in fact, yesterday on Friday. And as you can see, the implied volatility is pretty high. It's almost 100%. It's been going up, and because it's right before the earnings. And so when we look at the risk profile, so the one that I traded was actually January expiration options. And there's also the September one. So let's take a look at them in turn so that you can see exactly what I mean by when you set up 15 delta options that the price range is much wider with the longer duration. So for the January expiration, the one that I set up, it's minus 0.13 delta for the put side, and that's $34. And then the other one is the same delta number, 0.14 delta and that's $60. Whereas when you go to September, which is around 45 days to expiration, if you want to set up more or less the same thing, which is kind of difficult since they don't have the exact delta number, but let's say with the delta 0.10, which is $55, and then minus 0.15 will be around 39. So I already did that here. So let's go back to the risk profile. So I also kind of match the option numbers so that we will spend the same money and see what kind of returns that we can get. So let's take a look at the September one first. So we will be spending the same amount of money for margin. Obviously they have to keep some, TD Ameritrade needs to keep some money in the account to make sure that the trade doesn't, when the trade goes against you. And as you can see, you could get about $174 by selling 2 options on the call and put sides, and that's the credit you could get for September. And also the probability, the price range is much narrower. Whereas if you go with the ones that I traded, which is January expiration, so the probability of losing until expiration out of money is on the higher price side, it's about 13%. On the lower side, it's about 18%. So when you add it up, it's about 30%, 31 maybe. So that's the kind of 15-day order trade that we do. And so when you look at it, obviously you get $471 by spending the same amount of money for margin. Now let's take a look at what would happen when the volatility drops. So let's change that to minus 5%. So you can see, let's say you drop 5% right there. It's gonna go up to 173, whereas the other one, for the September one, shorter time duration, it will go up to about $69. So right there, you can see, okay, let's assume the price doesn't jump up and down until expiration. And let's say the implied volatility dropped 5%. Now I spend the same amount of money for margin, and guess what? I'm actually making more with the longer duration one. So that's the kind of thinking that sort of the kind of data that got me thinking, well, wait a minute, maybe longer duration is not that bad. Obviously, there are some positions that went against me. In fact, I have shared this in a different video, and I'll share again, sort of follow up on some of the trades that I did to show you, how using a longer duration might go wrong. But based on this data, it seems like it's gonna work. So, I mean, that's it for this video. I don't know what you think about this analysis, but I think there's a good potential to use a longer duration options for earning trades. So thank you for watching. And if you would like to follow up on the progress that I'm doing an experiment using these longer duration options, and to see if they go well or not, please subscribe to the channel or check out alphapursuit.com. And I hope to see you in the next video and have a chat with you in the comment section. Thank you.